Finally, let me talk about 6 secular growth trends and investment themes that I'm focusing on in the next 10 years. Okay? I hope you guys are enjoying it so far and learning something. Okay, so the first would be focus on businesses that provide enabling technologies. What does it mean? Like, I'm in the education business, right? And I can tell you that my business has completely transformed in the last 1 or 2 years, because now we are forced to go online. We are forced to use all this technology to run our business. If we don't, we are dead. Okay, so more and more businesses, whether it's a supermarket, it's a restaurant, it's an education company, you got to use technology to survive today. So companies that provide these technologies like 5G, artificial intelligence, big data analytics, and cloud computing, they will grow tremendously in the next 10 years. Okay, so what companies are these? First of all, which are the companies involved in big data and analytics? Illumina. Illumina is one of the leaders in genomic and DNA sequencing, right? DNA sequencing. Salesforce, a leader in customer relationship management software. Apple, obviously. Microsoft, Alphabet, and Cloudflare, just to name a few. Now, again, having said that, it doesn't mean that I would buy all these companies. These are companies in that industry. I will only invest in those companies that are fundamentally very strong. Like, look at Cloudflare. This company, I will not invest in it because it is overvalued. It doesn't have a strong competitive advantage. It is still a relatively young company. So for this company, I would trade using options. I will not invest in it, but I will invest in Salesforce. I'll invest in Microsoft. I'll invest in Apple. So you got to know which ones you can invest in, which ones you can only trade for the short term using options or swing trading techniques. And again, I cover all this in the courses, right? The value momentum investing class and the ultimate investors playbook, right? Next, cloud computing, cloud. You got to invest in cloud companies. The biggest cloud company is Amazon, followed by Microsoft, Alphabet, Alibaba. And if you don't want to buy individual cloud companies, you can buy the cloud ETF SKYY. SKYY is an ETF that invests in a portfolio of cloud companies, cloud enterprise. All right. Okay, so that's number one. Number two, e-commerce. This is a no-brainer, right? E-commerce will keep growing even after the pandemic. And it's projected to grow at 15 to 20% at least in the next 10 years. So who are the leaders in e-commerce? In the Western world, Amazon. All right, so I own Amazon because I want to conquer the West in e-commerce, right? In China and Asia, Alibaba. There's no second. Alibaba. Alibaba owns Taobao, Tianmao, Lazada, and many other platforms, okay? In Latin America, the leader is Mercado Libre. So those of you in my subscription, you would have seen me buy Mercado Libre a couple of months back, and now that is already up like 20 or 30% in just the last few weeks, all right? Ticker symbol MELY. Now, Shopify is another retail commerce business, but to me, Shopify is overvalued, and it's not something I'll buy as an investment, but I'll trade it in the short term using options, right? Sea Limited owns Shopee, and they are primarily in the Southeast Asia market. All right. I don't invest in C because I think it's overvalued as well. And I think that between C and Alibaba, I rather go with a stronger player, right? You've got many others at C as well. Or you can simply buy the ETF, which is iBuy. Okay, moving on. Moving on, we have got Fintech. That's another big thing, Fintech, right? So Fintech companies are companies that apply technology to finance. So it makes it easier for you and I to transfer money, to make payments, to borrow money, right? Financial software and all those things. So who are the players? PayPal, obviously. But I don't invest in PayPal. I don't like PayPal, right? When you take my course, you will know why I don't like PayPal. I don't like PayPal. Amazon, Apple, Alibaba, Tencent, Square, Mercado Libre. And of course, you can buy the ETFs like Finex and ARKF. My favorites, obviously, in Fintech China would be Alibaba and Tencent, right? Of course, Ant was supposed to be the leader, but it got killed by Winnie the Pooh. So we'll see what happens after that, right? Square is an interesting business. It's just that I would trade it, short-term trading, but I wouldn't invest in it because it is overvalued. And I don't find that the economic moat is as strong as, say, Amazon or Alibaba or Apple, okay? Okay, next. Health tech. This is something big. This is something that's going to change our lives. Okay. So this includes companies involved in anything from telehealth, which is like medical consultation online, to robot assisted surgery, to DNA sequencing, all right, to biotech. Yeah. So leaders would be Intuitive Surgical. Ticker symbol ISRG. This company makes robots for assisting with surgery. Okay. Teladoc. Apple. Apple is really big in healthcare right now. I've got my Apple Watch. I use it to monitor my heartbeat. I use it to measure my heart ECG, everything health. All right. So just to name a few. Next, renewable energy. I already talked about this. Okay. So we have it as a secular growth trend, plus with the new US administration, it should accelerate the trend into renewable energy. So again, I'm looking at this ETF, ICLN, and TN. Again, like I said, I'm not saying buy it now, because if you look at the chart, it is overextended. It's breathing out. Never buy the breathing out. Wait for breathing in to make an entry. And so this is something I watch like a hawk every day. And the moment it is time, I pull the trigger. All right. Finally, disruptive innovation. There are some companies that are involved in disruptive innovation, and these fall into 5 categories. DNA sequencing, that's going to disrupt healthcare. Robotics, that's going to disrupt multiple industries. Energy storage, AI, and blockchain. Okay. Now, again, these industries are going to grow. They're going to change the world. But it's highly risky to invest into the individual companies within these industries, because many of these companies are very speculative. You don't know which ones will make it and which ones won't make it. A lot of them have huge debt. They're overvalued. They don't have consistent income and cash flow. So because of that, I do not buy individual companies that are speculative, but I buy them collectively as an ETF. So one of the best managers of these ETFs would be ARK, A-R-K. And they've got many sub-ETFs. I like their ARK-K Innovation ETF and the ARK-G Genomic Revolution ETF. Now, you guys know I've said many times that I will not invest in Tesla, right? I've said this many times. I've got a lot of criticism from it, and that's fine, right? Because to me, Tesla is something that is too risky for me. I'm a chicken. I'm a chicken guy. I do not dare to buy companies that are too expensive and that have high. I'm just a chicken, right? But I'll buy an ETF that has Tesla inside. That's safer because I diversify my risk. Okay. Now, if you look at this genomic ETF that consists of all the DNA sequencing companies, these are the top 10 companies in DNA sequencing. They will change the healthcare industry. But again, if you look at them individually, if you study these companies, you'll find that many of them are losing money. They are speculative. They are overpriced. And they've got weak economic modes. So I won't buy any of them individually, but I'll buy them collectively as an industry. Okay? So just remember that. Give me a sec. Let me just log into my account again. Don't know why I got logged out. Okay. Strategy summary for 2021. Again, I remain bullish on the US markets with a lower expected return of probably 5 to 6% this year. Okay. US markets, like I said, in general, are currently overbought. They are currently overextended, breathing out. I wouldn't jump in now. I'll expect a healthy correction of at least 5%. Okay. I would invest in the index ETFs only after a 5 to 15% correction or breathing in prices to below their fair value. I will only invest in fundamentally great businesses that are still fairly or undervalued. And like I said, don't make this mistake of buying a business just because it is cheap. Some students, they say, Adam, this stock I'd like to buy is undervalued, it's cheap. Yeah, I know, but it's a lousy company. Don't buy a lousy company just because it's cheap. You only buy a very good business only when it's undervalued. All right. So what makes a very good business? I'll again emphasize it again in a short while. But I'm going to give you two examples right now of companies that I think are great companies, but they are still fairly priced. One of them is Salesforce. Ticker symbol CRM. Salesforce is the leader in customer relationship management software for enterprises. And Lockheed Martin. Lockheed Martin is the biggest military defense contractor in the US and the world. So you know those F-16 fighter planes, F-5 fighter planes, they are all manufactured by Lockheed Martin, all right? So let me give you an example of, say, Salesforce. Now, again, what makes a great business? If you take my investing course, the value momentum investing course, I've got 7 criteria that make a great business. And again, like I said, guys, less than 1% of businesses can meet my criteria. So for example, in the US, there are 4,000 companies you could invest in. Only 40 companies meet my criteria, are investable, in my opinion. Do I buy all 40? No. I only buy at any one time, maybe about 20 companies. So in other words, I only invest in the top 0.5% of companies at any one time. I've been in the markets for 28 years. I first started investing when I was about 17. I'm now 46. And for the first 8 years, I made all the stupid mistakes you can ever think of. All right. I went around in circles for 8 years. But in the last 20 years, I have never had a losing investment. I have never had a losing investment in 20 years. It's not because I'm lucky. It's not because I'm talented or smart. It's because I'm extremely conservative. I'm a chicken. That's what I say. I'm a chicken. I do not dare to buy Bitcoin. I'm a chicken. I do not dare to buy Tesla. Even if it goes up, I dare not buy. I'm a chicken. But I'd rather be a live chicken. Okay. So I'm very conservative. I only invest in companies that, again, have low debt, that are undervalued, that have consistent growth in sales and profits and cash flow, and have a wide economic moat. So, example, look at Salesforce, right? Look at the revenue in the last 5 to 10 years. It's growing consistently. Can you see that? Right? The net profit also growing consistently. This is the operating cash flow. Cash flow in gray increasing consistently. Free cash flow increasing consistently. Do you think all companies can do this? No. Less than 5% of companies pass this first criteria, having consistent free cash flow and sales. Look at the cash, right? The cash is green, is increasing. The debt is also increasing, but there's more cash than debt. So it's a pretty safe company, right? Now, again, write this down. Write this down, everyone. A great business can be a bad investment if you pay too high a price for it, if you overpay for the shares. But a great business is a fantastic investment if you buy at a good price. In other words, a good business is only a great investment if you buy the shares when the price you pay is below its intrinsic value. Then it's a good business, or at least near the intrinsic value. All right. So my secret sauce is in valuing businesses. You got to know how to value the business. And we use a discounted cash flow method to do it. So in my value momentum investing course, you'll be getting all these intrinsic value calculators. And you're going to learn how to calculate the value of a business. It takes less than 5 minutes, actually, right? So if you look at Salesforce, you can see we key in the current operating cash flow, 4 billion in cash they are generating a year. The total debt of the company is 2.6 billion. Cash and short-term investments, 9 billion. Currently, the company is growing at 22%, but we conservatively estimate that it will drop to 15% and 4% as time goes by. 900 million shares. So based on this, the intrinsic value is 223. That is the intrinsic value of the company. So what's the current price? So the current price as of yesterday, let's check it out. The current price of it as of yesterday is 225.77. 225.77. Okay, so it is slightly less than 1% above the intrinsic value. So it is not cheap. It is not cheap, but it is not that expensive yet. It is fairly priced. So when it's fairly priced, sure, you can buy a bit of shares, but not too much. But I'll wait for it to go lower. I'm watching for this to go lower to add more shares. Does this make sense? Okay. Now, at the same time, let me show you the chart. So if you look at the chart and I show you the weekly candles, can you see the wave patterns? Can you see the wave patterns, right? So wave up, wave down, wave up, wave down, breathe out, breathe in, wave up, wave down, wave up, deep breath, wave up, wave down, wave up, deep breath, wave up, wave down, deep breath. This was the COVID crash. This was the trade war. And this was, I can't remember, right? And then wave up. And now it's wave down. So now you can see that it is hitting my first level. Okay, this is the first level, 218. So at 218, I will add some shares. In fact, I've already bought some shares, right? Now it's gone up already, but I bought it when it was slightly undervalued. Okay. And if it retraces to the blue line, then I buy more. And the last level here, which you can see is a strong support, is 181. So these are 3 levels I will add. And once it breathes in, you can bet great business, hallelujah, it will go higher and higher over time. Okay, so that's an example. Okay, another example would be Lockheed Martin. Now, again, those of you, when you subscribe to my Ultimate Investors Playbook, every month I'll do a deep dive research into great companies. Okay, so for example, this is what it looks like. This was one of the research into Viva, and this was presented on the 29th of February. Okay, so you can see that these are all the things that I'll run through. The revenue, the net income, cash flow, and we will do a comparison, right, of the economic mode. So we do a deep dive research into this company. So at that time, it was selling at $154. So we started buying at 154 on the 29th of February. And let me show you where it is now. Right, so if you look at Viva, so we bought it here. Yeah. Breathe out, breathe in, breathe out, breathe in, bounce. So we bought it here at 154. And now you can see it's now at 288. But this is only just beginning, right? I see a lot more upside for this company, by the way, Viva, right? And the other one is Lockheed Martin. As I mentioned, Lockheed Martin, if you look at the intrinsic value, it's $455. $455. And now Lockheed Martin is selling at $339. Right? So it is pretty, it's about 25% undervalued. 25% undervalued. So this is a pretty good value right now. Now you can see a strong support over here. Right? You can see deep breath, breathe out, breathe in, breathe out, breathe in. Now it still could go lower, as you can see, but eventually this guy's going to fly. How do I know? Because the fundamentals don't lie. The company's increasing sales, profits, cash flow consistently. All right. Let me just show this to you. This was our deep dive research into Lockheed Martin. You can see they make these fighter aircraft, right? Look at the revenue. Look at their income and their cash flow. So very, very consistent growth in their sales, profits, and cash flow. All right. So these are the kind of things that you will learn in the course, how to do your own research. And if you want me to do the research for you, then that's what I do in the subscription. Okay. Give me a sec. Let me just see. Okay. Yeah, there we are. Okay. Okay, let's continue. Now, at the same time, as part of my strategy, I will monitor the stocks and ETFs with secular growth drivers, which I mentioned the themes, enabling technologies, renewable energy, fintech, health tech, and disruptive technologies. I will enter once they retrace to attractive levels. And I'm watching them every single day to pull the trigger. Now, in my portfolio, I do both investing and trading. Okay. Why? Because investing is more long-term, trading is for short-term income. And when I trade, I generate profits that I use to buy more companies. So my favorite trading strategies are using options like bull put spreads, cash secured puts, covered calls, and snipebacks. And my target is to beat the market every year, which I've done every year, with at least a 20 to 30% return. That's my target. And I know most of my students are getting even higher returns. That's great. But please do not over leverage and do not over speculate on your portfolio, right? Be safe, follow the rules. If you get a 20, 30% return a year, that's pretty good, right? So just to show you, this is one of my trading portfolios. Okay, and these are short-term trades. You can see, let me open them up, right? You can see I'm using options. I've got Amazon, CHDR, DDoc, Facebook, Fiverr, Lockheed Martin as well, Lululemon. Oops. Like I said, this company, NET, I won't invest in it, but I will trade it using options, right? So you can see I just entered some options trades over here. And so far, you can see these are my profits right now, about $4,600 in profits, open profits. And so far for the year, I'm up about $4,600 year to date, right? So this is just to generate short-term profits and short-term income, which I then use, and I use it to buy more companies, all right? Finally, I remain bullish on Chinese stocks and ETFs and focusing on those with secular growth drivers and have no debt. All right, so that's my game plan for 2021.